Welcome to Chatbotcasts, where today we're diving into the world of cryptocurrency. I'm your host, and I'm excited to have with us an expert in cryptocurrency to guide us through this fascinating topic. Let's start with the basics. Can you explain what cryptocurrency is and how it differs from traditional money? How does its digital nature and the use of cryptography set it apart?
World of cryptocurrency. Cryptocurrency is essentially a digital or virtual currency that is secured by cryptography, making it nearly impossible to counterfeit or double spend. Unlike traditional currencies, which are physical and regulated by central banks, cryptocurrencies operate on a decentralized system. Let me think. One of the key differences is how they are created and distributed. Traditional currencies are created through monetary policy by central banks, where they adjust interest rates and other monetary tools to regulate the money supply. In contrast, cryptocurrencies are created through a process called mining, where users solve complex mathematical equations to verify and record transactions on a decentralized ledger known as a blockchain. The use of cryptography is what really sets cryptocurrencies apart. It ensures that transactions are secure and transparent. When you make a transaction using cryptocurrency, it's not just a simple transfer. It's a transaction that is broadcast to the entire network, where it is verified by miners using cryptographic techniques. These transactions are then grouped into blocks and added to the blockchain, which is a public ledger that anyone can view and verify. Interesting, right? This decentralized nature and the use of cryptography mean that cryptocurrencies are not subject to the same regulations and restrictions as traditional currencies. They offer greater privacy and security, since transactions are recorded in a public ledger that does not reveal personal information. So, in essence, cryptocurrency combines the digital age with advanced cryptographic techniques to create a new form of money that operates independently of traditional financial systems.
That's a great explanation of what cryptocurrency is and how it differs from traditional money. Now, let's dive a bit deeper into the technology behind it. How does the concept of blockchain technology fit into the world of cryptocurrency? Can you explain blockchain as an unchangeable ledger that records and verifies transactions?
Absolutely. Let's delve deeper into the blockchain technology, which is the backbone of cryptocurrency. Blockchain technology is essentially an online ledger that records and verifies transactions in a way that makes them virtually unchangeable. Imagine a big book where all transactions are written down, but instead of being kept by a single entity, this book is distributed across a network of computers. Here's how it works. When a transaction is made, it is broadcast to the entire network. This transaction, along with several others, is then grouped into a block. Miners, who are essentially powerful computers and their operators, compete to solve a complex cryptographic puzzle to validate this block of transactions. Once a miner solves the puzzle, the block is added to the blockchain, which is this public ledger. The interesting part is that each block is linked to the previous one through a unique code, creating a chain of blocks, hence the term blockchain. This linking makes it extremely difficult to alter any transaction once it has been recorded, because you would need to change the entire chain, which is practically impossible given the distributed nature of the network. This decentralized and transparent system ensures that all transactions are secure, trustworthy, and publicly verifiable. Anyone can view the blockchain to see the history of all transactions, but they cannot alter them. This is what makes blockchain technology so robust and reliable, and it's the reason why cryptocurrencies can operate without the need for central authorities or intermediaries. So, in essence, blockchain is not just a ledger, it's a secure, transparent, and decentralized way of recording and verifying transactions, which is fundamental to the functioning of cryptocurrencies.
Now we have a clear understanding of what cryptocurrency is and how blockchain technology works. Let's walk through the process of how a cryptocurrency transaction is made and verified. Can you explain the role of miners, nodes, and the consensus mechanism in validating these transactions? How do these components work together to ensure the integrity of the blockchain.
Let's break down the process of how a cryptocurrency transaction is made and verified, and how the various components work together. When a user, say Alice, wants to send some cryptocurrency to Bob, she initiates the transaction by sending an electronic message to the entire network. This message includes details like the amount of cryptocurrency being transferred, the electronic addresses of Alice and Bob, and a timestamp. These transactions are then collected into a block by miners. Miners are powerful computers and their operators who compete to solve a complex cryptographic puzzle. This puzzle is essentially a mathematical problem that requires significant computational power to solve. The first miner to solve the puzzle gets to add the new block of transactions to the blockchain. Now let's talk about nodes. Nodes are essentially computers on the network that verify and relay transactions. When a miner solves the puzzle and adds a new block to the blockchain, nodes on the network check the solution to ensure it is valid. This consensus mechanism, often referred to as a proof-of-work system, ensures that all nodes agree on the state of the blockchain. Once the nodes verify the block, it is added to the blockchain and the transaction is confirmed. The consensus mechanism is crucial here. It ensures that the blockchain remains consistent across the entire network. Since the blockchain is a distributed ledger, this consensus is what prevents any single entity from altering the transactions. It's a collective agreement among all nodes and miners that maintains the integrity and trustworthiness of the blockchain. In essence, miners validate transactions by solving cryptographic puzzles, nodes verify these validations, and the consensus mechanism ensures everyone agrees on the state of the blockchain. This interplay between miners, nodes, and the consensus mechanism is what makes the blockchain secure, transparent, and reliable.
And verified, let's discuss some of the key benefits and risks associated with using cryptocurrency. What are some of the main advantages, such as transparency and security, and what are some of the significant risks, like volatility and the potential for hacking?
Let's dive into the benefits and risks of using cryptocurrency, as it's a crucial aspect to understand for anyone considering this form of currency. One of the main advantages of cryptocurrency is its transparency and security. Since transactions are recorded on a public ledger, the blockchain, anyone can view the history of all transactions. This transparency, combined with the use of cryptography, makes it nearly impossible to counterfeit or double-spend cryptocurrencies. The decentralized nature of cryptocurrencies also means they are not subject to the same regulations and restrictions as traditional currencies, offering greater privacy and security. Another significant advantage is the speed and efficiency of transactions. Cryptocurrency transactions can be processed much faster than traditional banking systems, and they can be done 24/7 without the need for intermediaries. However, there are also some significant risks to consider. One of the most notable risks is volatility. The value of cryptocurrencies can fluctuate wildly, making them a high-risk investment. For example, Bitcoin's value has seen dramatic swings over the years, which can be both an opportunity and a threat to investors. Another risk is the potential for hacking. While the blockchain itself is secure, the exchanges and wallets where people store their cryptocurrencies can be vulnerable to cyber attacks. There have been several high-profile cases where hackers have stolen large amounts of cryptocurrency from these platforms. Additionally, there's the issue of energy consumption. The process of mining, which is necessary to validate transactions, is extremely energy-intensive. This has raised concerns about the environmental impact of cryptocurrency mining. In summary, while cryptocurrencies offer unique benefits such as transparency, security, and speed, they also come with significant risks like volatility, potential hacking, and environmental concerns. It's important for users and investors to be aware of these factors when deciding whether to engage with cryptocurrencies.
Let's move on to discussing some of the most well-known cryptocurrencies. What are some of the most popular cryptocurrencies, such as Bitcoin, Ethereum, and possibly Litecoin, and what makes them unique in terms of their history, use cases, and market stability?
Let's dive into some of the most well-known cryptocurrencies and what makes them unique. Bitcoin, often referred to as the granddaddy of cryptocurrencies, is the first and most widely recognized. It was created in 2009 by an individual or group using the pseudonym Satoshi Nakamoto. Bitcoin's history is marked by its pioneering role in introducing blockchain technology and decentralized currency to the world. It is primarily used as a store of value and a medium of exchange, similar to traditional currencies, but with the added benefits of decentralization and cryptographic security. Bitcoin's market stability is relatively high compared to other cryptocurrencies, although it is still known for its volatility. Ethereum, on the other hand, is not just a cryptocurrency, but also a platform for building smart contracts and decentralized applications, dApps. Created in 2015 by Vitalik Buterin, Ethereum's unique selling point is its ability to execute complex contracts and facilitate the creation of new cryptocurrencies and tokens. Ethereum's use cases extend beyond simple transactions to include decentralized finance (DeFi), non-fungible tokens, NFTs, and more. Its market stability is influenced by the broader adoption of its platform and the ecosystem it supports. Litecoin is another popular cryptocurrency, often referred to as silver to Bitcoin's gold. Created in 2011 by Charlie Lee, Litecoin is designed to be faster and more lightweight than Bitcoin, with quicker transaction processing times. It uses a similar proof-of-work consensus mechanism, but with some technical differences that make it more accessible for everyday transactions. Litecoin's market stability is generally less volatile than some of the newer cryptocurrencies, but still subject to the fluctuations of the crypto market. Interesting to note, each of these cryptocurrencies has its own community and use cases which contribute to their unique positions in the market. While Bitcoin is a store of value, Ethereum is a platform for innovation, and Litecoin is a faster transactional currency. Understanding these differences can help investors and users make informed decisions about which cryptocurrency might be right for them.
Now that we've covered some of the most well-known cryptocurrencies, let's talk about altcoins. What are altcoins, and how do they differ from the more established cryptocurrencies like Bitcoin, Ethereum, and Litecoin? Can you give us some examples of altcoins and their specific features or use cases?
Let's dive into the world of altcoins, which are essentially alternative cryptocurrencies to the more established ones like Bitcoin, Ethereum, and Litecoin. Altcoins are created to either improve upon the existing features of cryptocurrencies or to offer entirely new use cases. They often arise from forks of existing cryptocurrencies or are built from scratch with different technologies and philosophies. For example, one popular altcoin is Dogecoin, which was initially created as a joke but gained a significant following. It's known for its fast transaction times and low fees, making it more suitable for small transactions and micropayments. Another example is Monero, which focuses heavily on privacy. Unlike Bitcoin, where all transactions are transparent and visible on the blockchain, Monero uses advanced cryptographic techniques to make transactions completely private. This makes it appealing to users who value anonymity. Cardano is another notable altcoin known for its strong focus on research and development. It uses a proof-of-stake consensus mechanism, which is less energy-intensive compared to the proof-of-work mechanism used by Bitcoin. Cardano also supports the development of smart contracts and decentralized applications. It's interesting to see how each altcoin has its own unique features and use cases. Some, like Stellar, are designed for cross-border payments and have partnerships with major financial institutions. Others, like Polkadot, aim to enable interoperability between different blockchain networks. In essence, altcoins offer a diverse range of options for users and investors, each with their own strengths and weaknesses. Understanding these differences can help people make more informed decisions about which cryptocurrency aligns best with their needs and goals.
Now that we've explored the diverse world of altcoins, let's move on to the practical aspects of investing and trading in cryptocurrencies. For someone new to cryptocurrency, What are the steps to start investing or trading, and how do they choose a reliable crypto exchange and a secure wallet?
To get started with investing or trading in cryptocurrencies, there are several key steps to follow, and it's important to be meticulous to ensure you're doing it safely and reliably. First, you need to choose a reliable crypto exchange. This is where you'll buy, sell, and trade your cryptocurrencies. Look for exchanges that are well established, have a good reputation, and strong security measures in place. For example, exchanges like Coinbase, Binance, and Kraken are popular and have a track record of security and reliability. It's also important to check if the exchange is regulated and compliant with local laws. Once you've selected an exchange, you'll need to create an account. This usually involves verifying your identity, which is a standard practice to prevent money laundering and other illicit activities. After your account is set up, you can deposit funds either in the form of traditional currency or other cryptocurrencies to start trading. Next, you'll need a secure wallet to store your cryptocurrencies. There are different types of wallets, such as software wallets, hardware wallets, and paper wallets. Hardware wallets, like those from Ledger or Trezor, are highly recommended because they offer offline storage, which is much more secure than keeping your cryptocurrencies online. When choosing a wallet, make sure it supports the type of cryptocurrency you're interested in and has good security features. It's also a good idea to use two-factor authentication and to keep your private keys safe and secure. Finally, before you start investing or trading, it's crucial to do your research. Understand the market, the risks involved, and the specific characteristics of the cryptocurrencies you're interested in. This will help you make informed decisions and avoid common pitfalls. It's also worth mentioning that it's a good practice to start small and gradually increase your investment as you become more comfortable with the process. And always remember, the cryptocurrency market can be highly volatile, so it's important to be prepared for fluctuations in value. In summary, choosing a reliable exchange, setting up a secure wallet, doing thorough research, and starting small are the key steps to safely and effectively start investing or trading in cryptocurrencies.
Now that we've covered the steps to start investing or trading in cryptocurrencies, let's talk about some common trading strategies for beginners. Can you explain the differences between hodling, day trading, and swing trading, and which approach might be most suitable for someone just starting out?
When it comes to trading strategies in the cryptocurrency market, there are several approaches that beginners should be aware of, each with its own risks and rewards. Let's start with hodling, which is essentially a long-term investment strategy. The term HODL originated from a typo in a forum post and has since become a popular acronym for Hold On for Dear Life. This strategy involves buying and holding onto your cryptocurrencies for an extended period, regardless of market fluctuations. It's a good approach for those who believe in the long-term potential of a particular cryptocurrency and are not bothered by short-term price volatility. For someone just starting out, hodling can be a simpler and less stressful approach, as it doesn't require constant monitoring of the market. Day trading, on the other hand, is a more active and risky strategy. It involves buying and selling cryptocurrencies within a single trading day, aiming to profit from the price movements. This approach requires a lot of market knowledge, technical analysis skills, and the ability to make quick decisions. It's not recommended for beginners because it can be very stressful and requires a significant amount of time and effort. Swing trading falls somewhere in between hodling and day trading. It involves holding onto cryptocurrencies for a shorter period than hodling, typically from a few days to a few weeks. This strategy aims to capture the medium-term trends in the market. Swing trading requires some market analysis and the ability to set clear entry and exit points, but it is generally less demanding than day trading. For someone just starting out, I would recommend starting with hodling. It allows you to get familiar with the market without the pressure of making frequent trades. As you gain more experience and confidence, you can consider more active trading strategies like swing trading or even day trading, but it's important to understand the risks and do thorough research before diving in. It's also important to remember that no matter which strategy you choose, it's crucial to set clear goals, manage your risk, and stay informed about market conditions. This will help you navigate the often volatile world of cryptocurrencies more effectively.
Next up, dealing with cryptocurrencies. How important is security when dealing with cryptocurrency, and what types of wallets are available to ensure your investments are protected?
Dealing with cryptocurrencies, as the nature of these digital assets makes them vulnerable to various types of threats. The decentralized and digital nature of cryptocurrencies means that if your funds are compromised, it can be extremely difficult, if not impossible, to recover them. Let's start with the types of wallets available. There are several options, each with its own set of security features. Software wallets, which are installed on your computer or mobile device, offer convenience but are generally less secure than other types because they are connected to the internet and can be vulnerable to hacking. Hardware wallets, on the other hand, are highly recommended for their robust security. These wallets store your cryptocurrencies offline, making them much harder to hack. Brands like Ledger and Trezor are well known for their secure hardware wallets. They often come with additional security features such as PIN codes, physical buttons, and even recovery seeds in case you lose your wallet. Paper wallets are another option, which involves printing out your public and private keys on a piece of paper. This method is very secure since it's not connected to the internet, but it requires careful handling to avoid losing or damaging the paper. In addition to choosing the right type of wallet, it's crucial to use best practices for security. This includes enabling two-factor authentication, keeping your private keys safe and secure, and regularly updating your wallet software to protect against any known vulnerabilities. It's also important to be cautious of phishing scams and other types of cyber attacks. Always verify the authenticity of websites and exchanges before entering your credentials, and never share your private keys with anyone. In summary, security is not just important, it's essential when dealing with cryptocurrencies. By choosing the right type of wallet and following best security practices, you can significantly reduce the risk of losing your investments.
Now that we've covered the importance of security and the types of wallets available, let's look towards the future of cryptocurrency. What are some current trends and future predictions in the world of cryptocurrency, such as advancements in decentralized finance, DeFi, or the rise of non-fungible tokens, NFTs?
Let's look towards the future of cryptocurrency, which is certainly exciting and full of potential. One of the current trends that's gaining a lot of traction is the advancement in decentralized finance, or DeFi. DeFi platforms are leveraging blockchain technology to create financial services that are decentralized, transparent, and accessible to everyone. This includes lending protocols, stablecoins, and decentralized exchanges, DEXs. The idea is to replicate traditional financial services, but in a way that's more inclusive and less reliant on central authorities. Another significant trend is the rise of non-fungible tokens, or NFTs. NFTs are unique digital assets that represent ownership of a specific item, such as art, music, or even real estate. They're built on blockchain technology, which ensures their scarcity and provenance. NFTs have opened up new avenues for creators to monetize their work and for collectors to own unique digital items. It's also interesting to note the growing adoption of Layer 2 scaling solutions. These solutions aim to improve the scalability of blockchain networks, making them faster and more efficient. Technologies like sharding, roll-ups, and sidechains are being developed to handle higher transaction volumes without compromising the security and decentralization of the blockchain. Looking ahead, we can expect even more innovation in the space. For instance, the integration of artificial intelligence, AI, and blockchain could lead to more sophisticated smart contracts and automated decision-making processes. Additionally, the emergence of central bank digital currencies, CBDCs, might blur the lines between traditional and digital currencies, potentially leading to a more hybrid financial system. In summary, the future of cryptocurrency is filled with promising trends and technologies that are set to transform the financial landscape. From DeFi and NFTs to scaling solutions and AI integration, there's a lot to look forward to in this rapidly evolving field.
Now, exciting future trends in cryptocurrency, let's open the floor for some questions from our listeners. Do you have any advice or tips for our audience who might have questions about getting started with cryptocurrency or navigating the current market?
For anyone looking to get started with cryptocurrency or navigating the current market, I have a few key pieces of advice. First, do your research thoroughly. Understanding the basics of how cryptocurrency works, including the blockchain technology and the role of miners, is crucial. It's also important to stay updated on the latest developments and trends in the crypto space. When choosing a cryptocurrency to invest in, consider the project's underlying technology, its use cases, and the community support. Don't just follow the hype. Look for projects with real-world applications and a strong development team. In terms of security, this cannot be overstated. Always use a reputable exchange and a secure wallet. Hardware wallets are your best bet for long-term storage, and make sure to enable two-factor authentication wherever possible. For those new to trading, I recommend starting with a hodling strategy. It's less stressful and allows you to get familiar with the market without the pressure of frequent trades. As you gain more experience, you can consider more active trading strategies. Lastly, be cautious of the volatility in the crypto market. Prices can fluctuate rapidly, so it's important to set clear goals and manage your risk. Don't invest more than you can afford to lose, and always keep an eye on market conditions. It's also worth mentioning that the crypto community is very active and supportive. Joining online forums, social media groups, and attending webinars can be a great way to learn from others and stay informed. In summary, getting started with cryptocurrency requires a combination of knowledge, caution, and patience. By doing your research, prioritizing security, and managing your risk, you can navigate the crypto market more effectively and make informed decisions.
Now that we've covered the advice for getting started and navigating the crypto market, let's summarize the key points discussed today and open the floor for any final questions from our listeners. Can you briefly recap the main takeaways from our conversation, and are there any common FAQs or misconceptions about cryptocurrency that you'd like to address before we conclude?
To summarize the key points from our conversation, let's start with the basics. Cryptocurrency is a digital or virtual currency that operates on a decentralized system, secured by cryptography and recorded on a public ledger called a blockchain. Unlike traditional currencies, cryptocurrencies are created through a process called mining, where users solve complex mathematical equations to verify and record transactions. We discussed how blockchain technology is the backbone of cryptocurrency, ensuring transactions are secure, transparent, and virtually unchangeable. The role of miners, nodes, and the consensus mechanism in validating transactions is crucial for maintaining the integrity of the blockchain. We also explored the benefits and risks of using cryptocurrency, including its transparency, security, speed, and volatility. We touched on some of the most well-known cryptocurrencies like Bitcoin, Ethereum, and Litecoin, as well as altcoins, each with their unique features and use cases. For those looking to invest or trade in cryptocurrencies, we emphasize the importance of choosing a reliable exchange, setting up a secure wallet, and doing thorough research. We discussed various trading strategies such as hodling, day trading, and swing trading, recommending hodling for beginners. Security is paramount, so we highlighted the need for secure wallets, two-factor authentication, and caution against phishing scams. Looking to the future, we talked about trends like decentralized finance, DeFi, non-fungible tokens, NFTs, and Layer 2 scaling solutions. For final advice, it's crucial to do your research, prioritize security, and manage your risk. Don't invest more than you can afford to lose, and stay informed about market conditions. As for common FAQs or misconceptions, one frequent misconception is that cryptocurrencies are completely anonymous. While they offer greater privacy, transactions are still recorded on a public ledger. Another misconception is that cryptocurrencies are only for illicit activities. In reality, they have a wide range of legitimate use cases. If you have any final questions or need further clarification on any of these points, now is the time to ask.
Given that we've opened the floor for listener questions, let's address a common query that often arises. Can you clarify how someone can protect their cryptocurrency investments from hacking and other cyber threats? And what are some best practices for securing digital wallets?
Protecting your cryptocurrency investments from hacking and other cyber threats is crucial, and there are several best practices you can follow to ensure your digital wallets are secure. First and foremost, choosing the right type of wallet is key. Hardware wallets, such as those from Ledger or Trezor, are highly recommended because they store your cryptocurrencies offline, making them much harder to hack. These wallets often come with additional security features like PIN codes, physical buttons, and recovery seeds in case you lose your wallet. For software wallets, make sure to use reputable and well-maintained options. Always enable two-factor authentication, 2FA, to add an extra layer of security. This way, even if someone manages to get your password, they won't be able to access your wallet without the 2FA code. It's also important to keep your private keys safe and secure. Never share your private keys with anyone, and avoid storing them in easily accessible places. Phishing scams are common, so always verify the authenticity of websites and exchanges before entering your credentials. Regularly update your wallet software to protect against any known vulnerabilities. Back up your wallet and store the backup in a secure location, such as a safe or a secure cloud storage service. Another good practice is to use a combination of hot and cold storage. Hot storage refers to wallets that are connected to the internet, which are convenient but more vulnerable. Cold storage, like hardware wallets, is more secure but less convenient for frequent transactions. Finally, be cautious of public Wi-Fi and public computers when accessing your cryptocurrency accounts. These can be easy targets for hackers, so it's best to use a secure, private connection. By following these best practices, you can significantly reduce the risk of losing your cryptocurrency investments to hacking and other cyber threats. Remember, security is an ongoing process, so stay vigilant and keep your knowledge up to date.
Thank you for tuning in to Chatbotcast. We hope you enjoyed this episode and found it engaging. Don't forget to subscribe so you never miss an update, and visit us at www.chatbotcasts.com to explore more exciting episodes. See you next time, and happy listening.